fundsupermart.com.
Hello everyone, with us today is Dan, the head of Pan European Equities at Threadneedle, and he will explain why should investors consider investing in the European equities right now. Hello Dan, in your view, will Greece leave the Eurozone, and would the re-election in mid-June change the situation?
I mean, our house view at Threadneedle is that ultimately Greece will leave the Eurozone, but we are concerned that the elections on the 17th of June will prove to be inconclusive. Ultimately, the Greek population would seem to want to have their cake and eat it. They seem to want to reject the austerity measures proposed by the Troika. However, at the same time, they want to keep Greece into the euro. So ultimately, we think the most likely scenario for Greece post the 17th of June elections will be effectively what we consider the muddle through scenario. So we think that what will happen is that the Greeks will remain in the euro for the time being, but ultimately the support lines being given to the Greeks will ultimately be done through the ECB. At the moment, the ECB is guaranteeing around 100 billion euros of funding to the Greek banking system, and it's that lifeline, if you like, of funding from the ECB to the Greek banking system that is preventing the Greek banking system from collapse at the moment. The other options would be a fast exit of Greece. We see this as quite unlikely. We don't see that the Greek population at the moment indicating that they wish to leave the euro in a fast way. Obviously, that would be a fairly dramatic outcome, ultimately probably quite good for the rest of the Eurozone. And the other option would be a slow exit of Greece and the Eurozone, which would be a more negotiated option, and therefore one which, again, we think ultimately would be quite positive for the rest of the Eurozone.
While austerity measures don't seem to help the situation, and the market is calling for a need to boost economic growth, how would the situations play out in the peripheral countries in Europe, and could the governments balance growth with budget cuts?
The problem has always been that the measures that we're looking at focus purely on on one side of the equation and not the other. Clearly, by implementing significant austerity measures within the periphery, you are going to affect the growth outlook for those countries, and without growth, we see the negative spirals that have already started to occur in Greece, but also in countries like Spain and Portugal and Italy. So our feeling has been all along that there has to be a more concerted effort to boost growth in the Eurozone as a whole. That ultimately will come from the Germans, and that measure is likely to be in the form of a stimulus. We have seen, obviously, the LTRO, the long-term refinancing operation, which was put in place at the end of last year, which has served to at least in the short term, provide a form of liquidity boost to the European economy in the first quarter. We think that the measures required need to go further than this, and ultimately we're looking at a European-wide growth pact, which we think will come sometime in the next few months when we see the meeting of the Eurozone leaders taking place towards the end of June. But we would agree that the ability of these peripheral governments to actually balance their financial books would seem very, very unlikely without some form of growth stimulus, and that growth stimulus obviously will be good for the whole of the Eurozone.
What will be the most likely outcome of this Eurozone crisis?
Longer term, we think that the most likely outcome would be ultimately a more unified Europe. We think that without fiscal union throughout Europe, you are unlikely to see the success of a monetary and currency union that we have currently. So we think that from a medium to long-term perspective, there are some quite positive outlooks for Europe as a whole. Europe actually, when you aggregate the whole of Europe, is not actually that indebted. The problem has been, as we now know, within the peripheral with the peripheral countries where governments have been able to borrow at rates which are inappropriate for their local economies, and they've used this borrowing to boost the standards of living in the periphery. We are now starting to see that adjustment take place. Now, ultimately, you will see a deleveraging taking place in those peripheral economies. But at the same time, we think that the structural reforms that will be introduced for Europe will lead to a more integrated Europe, and from that perspective, we can see some quite positive long-term benefits for the Eurozone as a whole. However, in the short term, it's very difficult to judge the likely timing of this, because clearly we are dealing here with politicians and not economists, and indeed, politicians are driven not by necessarily the best economic outcome in the medium to long term, more on their own personal gains in the short term. So it could continue to be a relatively messy situation in the short to medium term. But ultimately, we do think that the Germans will come around. Mrs. Merkel in Germany, the Chancellor, she is enjoying still relatively strong support within Germany. And the elections in Germany that take place in the second half of 2013, we think will ultimately end up in what's known as a grand coalition between the SPD and the CDU, which in reality is actually a very pro-European position for the Germans to be in. So although we think that the short-term position on the Eurozone isn't necessarily clear, we do think that the longer term is likely to be a positive solution for Europe.
Why should investors invest in a European fund when the crisis looks unresolved and would remain in the midterm?
Well, I think at the moment, the valuations in Europe offer essentially very, very much higher than average potential medium to long-term returns to compensate for the perception of the higher than average risk that currently exists in Europe on a macro basis. Whereas other developed market equities around the world, we think, offer lower than average returns for indeed continuingly high macro risks, whether it's in other parts of the world, such as the US, but also obviously Asia, the emerging markets, the UK, etc. So we think that the European equity markets currently are offering a sufficient level of valuation discount to the rest of the world to justify that extra macro risk that you must take on at this point when investing in European risk assets. But I would stress this is on a more medium to long-term basis. As I've said, the issue we have is more that in the short term, it's very difficult to forecast exactly on a week-to-week or a month-to-month basis exactly what the outcome will be. So our view is that for investors willing to take a slightly more longer-term view, you're being given a very good opportunity at the moment to invest in Europe at some very, very attractive valuation levels. We think there are a number of stocks that offer incredibly attractive returns, and we think that now is potentially a sort of once-in-a-decade type opportunity to be involved with European equities.
Lastly, where are the investment opportunities in the European equity markets, and what are your strategies to benefit from this region?
Well, Europe actually has a proportionally much higher exposure in its equity markets to the global economy than other developed market equities. Something like 50% of sales of European companies, quoted companies, take place outside of the Eurozone. Roughly 25% of profits at the moment for European equities come from the emerging markets, for example. So we think that within the European equity market there are some very, very attractive companies which are essentially offering the exposure to global growth and global earnings and global wealth creation. for example, which are being priced at a very, very attractive level because of the association with the Eurozone. So we think that from an investment point of view, we have been focusing on those international companies, and we will continue to focus on those internationally focused companies. At the same time, a lot of these companies are also offering very, very high levels of cash flow, and that cash flow is being channeled either into dividend streams, growing dividend streams, but also partially through things like share buybacks, and also we're starting to see pickup in the M&A market. So again, we find that because of these very, very attractive valuations, you are being given the opportunity to participate in that very, very strong cash flow that you see coming from Europe. To give you an example, the Nestle, one of the biggest companies in the world and the biggest company in Europe, and obviously a very international company, serving everywhere, all around the world. Currently, the dividend yield on Nestle is above 4%, and that's obviously in a very strong currency, the Swiss franc. That compares to the bond yield for Nestle bonds, which is currently trading at around, I think, 2.5%, which then compares to the sovereign bond yield for Switzerland, which is effectively 0. So you're able to buy an equity like Nestle, giving you more than 4% yield in Swiss franc terms, which is better than the bond yield, and it's certainly better than the sovereign yields that you're able to achieve in a hard currency like Swiss francs. And we think that that pricing of Nestle stock is still very, very attractive. This is a company which will continue to grow their sales in mid to high single digit, and they'll continue to grow their earnings in somewhere in the sort of 10 to 15% range going forward.